The market is closing the week quiet as investors await the outcome of today's 150 billion OMO auction. The Kenneth Onuoha team member in Assets and Liabilities at UBA joins me now for more market movements. That's at the fixed income market. Kenneth, thank you for joining us today.
Thank you for having me, Esther.
Well, do we have the results of the auction? If not, just walk us through market action today, starting with liquidity levels of the market and across the various segments.
All right. Thank you once again, Esther. The results are not out yet. However, we still keep our eyes fixated on that space to see what happens there. Let's do a quick roundup of what has happened this week. The week has been quite eventful. The liquidity space, we have for the first time seen elevated liquidity levels throughout the course of the week. Following FAC inflows on Friday last week, we saw an improved state of liquidity where the system opened on Monday with a net credit balance of 951 billion. Now, that has not happened in over a while now. And what we did see, however, was that following, of course, settlements of the NTB auction, net settlement of about 55 billion, and NNPC withdrawals, we saw that taper down to about 591 billion as at yesterday. Of course, that naturally prompted OPR and overnight rates to actually close at about 23.68 and 24.18% respectively. Moving on quickly to the bond space, it is quite interesting. This week had both the bond auction, the NTB auction, as well as now the OMO auction that was just notified that is currently being floated at the moment as we speak. On the bond auction space, we had a bond auction on Monday. This is the bond auction that was supposed to have held last week, but of course, owing to the public holidays that we saw last week, that was obviously shifted to this week. 450 billion was put up on offer across three maturities, namely the 2029s, 2031s, and 2033 respectively. And what we did see was that we saw it was undersubscribed. We saw subscription levels hit about 305 billion, and we saw the actual sales closed at about 297 billion. Stop rates, however, we saw an increase in the stop rate on the long end, 2023s, that closed in May at about with 19.89%, printed at about 21.5% in June. Moving on to the NTB space, we did have an NTB auction on Wednesday. 229 billion was put up on offer. We saw subscription levels hit about 3.5% off that which was on offer, which was about 704 billion. And then we saw the actual sales to close at about 284 billion. It was undersold. It was actually oversold by about 55 billion. Now, the stop rates, we saw it hold steady across these 91 and 182 days. But on the 364 days, we saw increase of about 18 basis points, close about 20.68%.
For the 91-day, the short tenured at the NTB market, where are rates now? Are we still, because I remember an analyst telling me yesterday, between 26 and 28%. Is that where we are right now?
No, so the yield, that is in terms of the yield, but
yield,
at the rate was about 16.3%, and that's what the 91 days closed. And then the 182 days closed at about 17.4%.
Right. Now, going forward, I mean, obviously with concerns around debt servicing and, the size of the current public debt, I know this was meant to be a short-term strategy for the central bank. Do you see this continuing, or at what point are we going to see a significant pullback?
We do expect, the general market sentiment is that, of course, we would see the rates begin to taper down towards the end of the year, third quarter into last quarter of the year. And that explains also why you have investor leanings towards the longer end securities, which would guarantee some form of high returns over time in the midst of the uncertainty that we currently face in the macroeconomic space. But of course, when we consider the debt servicing and debt profile, we would obviously expect that this rate will obviously drop.
Right, and now for H2 going into the second half of the year, can we expect the DMO to keep up the momentum in terms of course, the monthly bond auctions, or are we going to see the same levels for that we've seen in the first half?
We expect that the DMO would work in line with what is currently happening at the time, because essentially what we see currently now is the fact that the rates are obviously at elevated levels, but is it sustainable? Pretty doubtful that it will be sustainable over. So we expect that the momentum would obviously taper down towards the end of the year.
All right,
or
Kenneth,
start of the H2.
Okay, we'll leave it there. Thank you for talking to us today. We appreciate your time on the show. Kenneth Onuoha, team member, assets and liabilities at UBA, taking us through trading at the fixed income market this week.